last year, we've been looking for a first half of this year recession or recession effect, if you will. Our economists are more of the view that a recession condition is more of a second half. In either event, we think we begin to feel it now, which you're seeing, as you point out, in some of the manufacturing data, which is giving you readings that are typically a leading indicator of what you would expect going into a recession. So we think that issue is front and center. The way we're navigating it, quite simply, is that we think that S&P 500 earnings will not be as bad as feared relative to a recession circumstance. That said, there are still some yellow flags on the horizon where we think that earnings expectations are going to continue to come in. And the areas that kind of come into this discussion would include margin pressure. You then throw in top the increase in lending conditions, essentially a tightening there that continues to permeate its way through as a pretty important lead indicator for weakening economic activity and earnings. The net of this is that while the banking system is working through its issues, under the surface, the conditions have been deteriorating already. And again, this is why we would kind of, at this point say, okay, great, we've had a pretty good move. It's explainable from a couple of different angles: resilient earnings, falling interest rates. But from here, the risk-reward skews a little bit more to the negative in our view.
And Scott, more short-term, we've got non-farm payrolls out. It's a holiday shortened week with Easter as well. How big a risk event is this going to be for markets?
Well, it's the next issue to come up. I mean, I think that it'll be widely anticipated. I think it'll be a factor in terms of the Fed's next meeting expectation. But, I'd say, given that we are about to enter the Q1 reporting period, and in my view, that's probably going to be as if not more important in terms of setting the tone for management commentary about how the second half is going to shape up. Again, the rally on the back of a lower interest rate and a perception of a Fed change in direction as we move through the second half of the year is pretty clear. What I don't think the market's really fully prepared for at this point is for a further deterioration in earnings expectations while we're still navigating the next steps for the Fed, if you will.
Scott, so that takes us to talking about what kind of recession we're going to have here. And I think the remarkable thing is just how well the jobs market has held up here, whether it's labor hoarding or something else. We're going to get a look at the JOLTS today. That'll give us a bit more information here. But if we have a short and shallow recession, maybe a lot of equity investors will just hang on. Is there any prospect that it could turn out to be a lot worse than that?
Well, I think there's always that prospect. We are placing our highest probability on a mild recession, and so we're giving that like a 65% chance. We do hold out a 20% chance that there's a more severe recession out there, and that's where the Fed continues down a very hawkish path, even as economic activity is showing very clear signs of deteriorating. We're not there yet, but that's what we're on the watch for. In a mild recession, again, we think that what you have to expect is under the surface is a rolling sector response to this from a fundamental perspective. What this can do is take some of the pressure off of the way the market would typically respond to a recessionary circumstance. Doesn't mean it's not going to be an issue. It will be an issue, but we think that the U.S. equity market's opportunity to show resilience around this will actually be, in some ways, sort of a positive surprise versus others that I think have been a little bit more negative in terms of a recessionary outcome for the U.S.